So they've got this wonderful business with these fabulous returns and this #1 brand, and they can't spend any money on advertising, marketing, or now packaging.
Fantastic.
What's not to like?
Yep.
And then the final frontier. I mean, of course, if you think you've got this brilliant brand down there and you're going to compete with Marlboro, how do you do it? You can't advertise.
As Terry Smith, one of Philip Morris International super investor shareholders, has pointed out, tobacco is actually a great industry from an investment perspective. Government regulations have created high barriers to entry, and restricting on advertising and packaging has paradoxically improved economics by reducing unnecessary spending. At the same time, Philip Morris International is undergoing one of the most dramatic transformations in corporate history. While many investors view tobacco stocks as relicts of the past, Philip Morris International has seen its stock reach all-time highs recently. So today, we are going to go through our 7-step analysis process to understand what's really happening with this tobacco giant. Is this just a short-term spike, or is there a fundamental shift that could make this an valuable long-term investment? Philip Morris International is the largest publicly traded tobacco company in the world. Since splitting from Altria in 2008, it has focused on international markets, selling products in over 180 countries. The company's flagship brand, Marlboro, remains its crown jewel. But this company has been aggressively transitioning towards smoke-free products like IQOS heated tobacco and ZYN nicotine pouches. The company's goal is ambitious: to have smoke-free products constitute 67% of its total revenue by 2030, up from 39% today. But the question is, can they deliver on this vision while maintaining profitability? Let's start by looking at its historical performance. If you invested $1,000 into this company 10 years ago, you bought 13 shares. And today, they would be worth something close to $2,015. And this company also pays dividends. So in that time, you would get $587 as dividends. So if we add together those numbers, we get $2,602. And that is a gain of 160% in 10 years. That is a solid return, especially for a company in an industry many consider to be in decline. But let's see who's betting on Philip Morris International's future success. Individual insiders, that is an X. Only 0.2% of the company is owned by individual insiders, and we would like to see this number over 2%. So unfortunately, the management doesn't have much skin in the game. And are individual insiders buying? That is also an X. We actually see a number of sale transactions in the recent quarters. And the super investors on this company? That is a check with 8 super investors, including Thomas Russo, Terry Smith, and Lee Ainsley. And are super investors buying right now? That is an X. Super investors bought 2.1 million shares last quarter, but sold over 6.1 million shares. So overall, they were net sellers. Okay, so let's look at the fundamentals of this company. Return on invested capital, that is a check at 31.8%, and we want to see this number higher than 10%, so that is extremely impressive. The management is doing a great job here. And what do we know about net profit margin? It is a check averaging 25.3% over 5 years, and the industry median is 14.5%. This company's ability to maintain such high margins demonstrates its pricing power, its brand, and operational efficiency. And now let's take a look at share buyback. It is a check at 0.6% over the last 10 years. The negative number means they've been reducing the total number of shares outstanding, which is good for long-term shareholders. And the debt, it is an X. It would take nearly 4 years to pay off their long-term debt with a current free cash flow. And we want to see this number under 2 years. So that is not perfect. Now let's look at Philip Morris International growth trajectory. Revenue growth, that is an X at only 2.4% 10-year compound annual growth rate. We would like to see this number higher than 10%, so that's disappointing. Free cash flow growth, that is also an X at 5% in the last 10 years. Better, but still below our 10% threshold. And earnings per share growth, that is another X at minus 0.5% in the last 10 years, so essentially flat. These growth figures might seem concerning. They confirm that tobacco stocks are relics of the past, but they don't tell the full story. Philip Morris International is in the middle of a major strategic pivot towards smoke-free products, which are growing much faster. The smoke-free segment grew by 14.2% in 2024 alone, and now represents 39% of total revenues. But what about the company's commitment to returning cash to shareholders? The dividend yield is 3.6%, so shareholders can expect to get $5.40 annually per every share. That's a decent yield in today's market. And the payout ratio, that is an X at 80.9%. We want to see the payout ratio somewhere between 20 and 50%, so this is quite high and could potentially limit future dividend growth. But it is not uncommon for tobacco companies to have such high payout ratios. And what about dividend growth? That is a check at 2.8% 5-year growth rate. While the company has consistently increased its dividend for years, the growth rate is rather modest. Now, let's determine if Philip Morris International is worth its current price. Price to earnings ratio is 33.2. That's well above the market average and suggests investors are paying a premium for its shares. To calculate the intrinsic value of this company, we will use a discounted cash flow analysis with 3 scenarios. In the low scenario, we will estimate a growth of 3% for the first 5 years and then 3% after that. In the medium scenario, 6% and then 5%. And in the high scenario, 12% and then 10% growth. The low scenario aligns with the predicted industry growth of around 3%. The medium scenario is showing a story in which Philip Morris International is outperforming the industry, and the high scenario assumes a successful execution of their smoke-free strategy. With these estimates, the intrinsic value in the low scenario is $70, in the medium scenario $89, and in the high scenario $146. After applying a 30% margin of safety, we get in the low scenario $49, in the medium $62, and in the high one $102. And the current price is around $155, which indicates that the stock is trading above our valuation range. However, it's worth noting that the high scenario without the margin of safety is not that far off to the current price. So it is expensive, but depending on which story do we believe in, it may not be crazy expensive. Okay, let's now put everything we've learned into perspective. Philip Morris International presents an interesting case. On one hand, it has incredible financial health with exceptional return on invested capital and profit margins. The company's aggressive change to smoke-free products like IQOS and ZYN is showing promising results, with these products now accounting for 39% of total revenues and growing much faster than traditional cigarettes. On the other hand, the stock appears overvalued based on our analysis, and there is significant debt on the balance sheet. A major milestone for the company is the recent Canadian tobacco settlement. Philip Morris International will have to pay around $8 billion as a part of the settlement. The company will pay $3.5 billion upfront, with the rest spread over 12 to 14 years. While this creates a significant financial obligation, it removes a long-standing legal uncertainty and, what is very important strategically, it excludes smoke-free products from future payment calculations, supporting the transformation towards alternatives like IQOS and ZYN. Let's go to our Stock Ranking Pro, which you can get access to by becoming a Patreon, and let's compare Philip Morris International with some of its peers. When we filter our stock ranking to show only tobacco companies, Philip Morris International is the most expensive of the four major players. But it also has the highest return on invested capital and net profit margin, suggesting you are paying for quality. The crucial question for investors is whether Philip Morris International's smoke-free transformation will continue to accelerate. If products like ZYN maintain their current growth trajectory, the company could potentially exceed our growth projections. However, with the stock already trading at an all-time high and super investors being net sellers last quarter, caution seems warranted at current prices. Thanks for watching and see you in the next one.